Hey everyone, this is Mark Treichel with another episode of With Flying Colors. Today's episode is going to be a little bit different. I'm going to respond directly to a podcast put out by the American Bankers Association, the ABA, on what they're calling the dangers of credit union member business lending. To be specific, March 30th, they issued a podcast called Are Credit Union Commercial Loans Risky Business? It's not that long of a podcast. I made it about halfway through and heard so many wrong statements that I decided I was going to do a podcast at that juncture. So I've been researching my memory on some things and putting a script together. I typically don't use much of a script when I do these things. The podcast that I'm referring to didn't use a script because they didn't even use any facts, quite frankly. A lot of their stuff was squishy. A lot of their stuff was wrong. And it's something I wanted to deal with here because credit unions do a good job in commercial lending generally, and I kind of want to set the record straight. So if you're listening to this for the first time, I spent 33 years at NCUA, the executive director at NCUA for the last 8 years of my career. And I also spent another 5.5 years since then in consulting. So in October, I'll have 40 years in the credit union industry. And so I know a lot about credit unions. I know a lot about how NCUA deals with credit unions. I was there when a lot of the things that the ABA claimed happened. And so I kind of want to give you my take on this and my facts on this. And again, the ABA has every right to advocate for its members. That's literally what they're paid to do. Banks and credit unions compete. Now that's a real reality. And when credit unions expand into commercial lending, banks feel it. Then they call their trade association and they say push back. So I understand that, but call it what it is. Advocacy dressed as analysis, and the range of what's going on here is pretty wide. At best, this is sloppy. At worst, it's an attempt to mislead the public about the credit union industry. I'll let you decide where on that spectrum this falls, but either way, it doesn't go unanswered because I'm going to answer it. So a former colleague of mine had a phrase that he used called roughly correct. It meant you're in the ballpark. The direction is right, even if the details are off. He would use it at the NCUA board table when he didn't want to embarrass an NCUA board member when they got it roughly correct and wanted to keep the meeting going. But the reality is what's in the ABA podcast isn't even roughly correct. The host invents a waiver process that doesn't exist. The economist conflates two completely different regulatory mechanisms. The stress testing argument ignores the most relevant data point in the entire discussion. That's not roughly correct. That's just wrong. So I listen to a lot of podcasts, and if you listen to my show, you know that. Listen to a lot of sports podcasts, Vikings, Timberwolves. There's a great sports podcast, which is solely about NFL football. It's called Check the Mic. And once a week, they review other podcasts and they call them the Shouty Shows. Now, what's a Shouty Show? It's Skip Bayless. It's Stephen A. Smith type content. So if you know who Skip Bayless is or Stephen A. Smith, you kind of know what I'm going to say. But it's loud opinions, selective facts, maximum outrage. They take a real topic, they strip out all the nuance, pick the most alarming angle and yell it confidently. So I listen to a lot of podcasts, a lot of sports podcasts, a lot of banking podcasts. I do it when I'm getting ready to go to bed. I do it when I wake up and go for a walk. If it's not music, I'm listening to a podcast. And one of my favorite sports podcasts is a show called Check the Mic. They have a segment on that show once a week where they talk about the Shouty shows, as they call them. Shows where people shout. That's the name they give for shows by Skip Bayless and Stephen A. Smith type content. Loud opinions, selective facts, and maximum outrage. They take a real topic, they strip out all the nuance, they pick the most alarming angle, and then they yell it confidently. It makes great content, but it's not analysis. In my opinion, that's what this episode of the ABA podcast is. It's the Shouty Show version of their take on credit unions. And today I'm going to do some fact checking. So fair warning, this episode is going to run longer than the one I'm responding to. They made their case in about 12 and a half minutes. It's going to take me longer to fact check their mistakes or their claims, if you will. And one more thing before we jump into the specifics. I love credit unions. The ABA loves banks. We both have a bias. I'm going to do my best to stick to the facts and show you my work. They didn't do either. So again, I spent my career inside the agency that regulates credit unions, and the last 5 years helping credit unions from the other side, having changed teams, if you will. I've seen examinations. I've seen the data. I've sat in the rooms where these decisions get made. And been in on some of these decisions that they're criticizing. So let's go through their claims one by one and look at what the data actually shows. So claim number one, but first, actually, before I get into claim number one, a little history of the ABA hopes that you've forgotten. Before I get into these specific claims, I want to give you some history because the ABA presents this as if it's a new concern driven by new data. It isn't. This is a 35-year campaign, and understanding where it started tells you everything you need to know about what is really motivating it today. The ABA filed a lawsuit challenging credit union field membership, specifically multiple common bond membership, back in 1990. Why field membership? Because more members meant more competition, more deposits, more loans, more relationships. The ABA wanted to slow that growth. That case wound its way through the courts and ended up in the Supreme Court. And guess what? The ABA was right, and they won by a vote of 5-4, written by Justice Thomas. The attorney who argued that case for the ABA, a fellow by the name of John Roberts, yes, the current Chief Justice of the United States, he won that case for the bankers. The Supreme Court decision threatened the existence of over 1,000 credit unions overnight. Congress responded with H.R. 1151, the Credit Union Membership Access Act, signed into law in 1998. It fixed the field of membership problem. The ABA lost the legislative battle. So they won the court battle. Credit unions rallied. Congress said, hey, these credit unions have a lot of power. We like credit unions. So they came up with a fix. Now, this is where it becomes interesting. To get H.R. 1151 through the Senate, there had to be a compromise. And that compromise was the 12.25% member business lending cap. Now, there's another podcast, Credit Union Conversations, with Mark Ritter, who had Todd Harper and Mike Radway, formerly of NCUA and formerly involved in 1151 and other things in Congress, on. And I had listened to that podcast, and I know some of the history, but I'm connecting now. In a little bit, I'll be connecting the podcast that Mark Ritter did on 1151 and the ABA podcast that I'm talking about that came out a couple of days ago. So Mike Radway, who helped draft that legislation and was in the room when it happened, described it plainly in a recent episode of the Credit Union Conversation podcast. The cap was there to assuage, this is Mike's word, assuage Senator Richard Shelby of Alabama. Shelby needed something he could point to and say to the bankers, I voted for this bill, but I got you something. And that something was the MBL cap. Now think about that for a moment. The ABA didn't sue over business lending. They sued over field of membership. But when Congress handed them a legislative defeat on field of membership, they were happy to take a cap on commercial loans as part of the deal. Law and sausage, right? What are the two things you don't want to see being made? Law and sausage. Because commercial loans are where the fees are. Origination fees, servicing fees, relationship banking, cross-sells. That is a very profitable line of business. The cap was a 2-for-1. They lost on field of membership, but walked away with a constraint on the most lucrative product banks offered their members. That wasn't about protecting safety and soundness, as alluded to in the ABA Banking Journal podcast. This was about protecting bank revenue. There's one more historical irony worth noting. The cap that was designed to limit credit union business lending actually had the opposite effect, according to Mark Ritter, the host of Credit Union Conversation podcast, who featured this history lesson, made an observation that stuck with me. He said the cap jump-started the credit union business lending industry. It helped create the QSO ecosystem. It helped credit unions working together and raised the flag that said if this is a legitimate thing to do. Mike Radway called it the law of unintended consequences. You put in place a limit thinking you're going to stop something, and all you did was wave a red flag. So the next time you hear the ABA talking about safety and soundness concerns around credit union business lending, remember they created the conditions that produced the cap. They extracted it as a consolation prize after losing on field membership. And the cap ended up growing the very industry they were trying to constrain. Keep all of that in mind as we go through their claims. So claim one was the 2016 rule change was a relaxation that opened up the floodgates. Wrong. Let me start with a direct quote from the ABA podcast because I want you to hear exactly what they said. The host asked about, and I'm quoting, these waivers that come from NCUA to operate above the cap, and whether it's a rubber stamp for credit unions to exceed the 12.25% limit. The economists respond that the 2016 change had to do with the change in the waiver process where pretty much you could go ahead and self-certify, and really there was a relaxation there, end quote. These are two separate errors running together in that exchange, and I want to untangle them both because they go to the heart of whether this is sloppy work or something worse. Error one, the host says NCUA issues waivers to let credit unions operate above the 12.25% cap. That's just factually wrong. There are no such waivers. There never were. The cap is set by statute by the Federal Credit Union Act itself. To operate above it, you either had to be a credit union chartered specifically for the purpose of member business lending or hold a low-income designation. Both of these are statutory provisions. Congress put them there. NCUA has no authority to waive the statutory cap. And the economist sitting right there never corrected the host. That alone should tell you something about the rigor of their analysis. What NCUA actually eliminated in 2016 were loan-level underwriting waivers under Part 723 of NCUA's regulations. Under the old rule, credit unions had to come to NCUA and get case-by-case approval for specific underwriting exceptions. Things like making a commercial loan above 80% loan-to-value, waiving the 25% equity interest requirement, or waiving the personal guarantee requirement. NCUA was literally approving individual loan parameters and individual loans. And here's what NCUA's own record shows. By the time the 2016 change, there were over 1,000 active MBL waivers. Over 1,000. NCUA itself acknowledged the waivers had become the norm rather than the exception. This is not a well-functioning regulatory system. This was a bureaucratic bottleneck. So what did NCUA do? They eliminated the prescriptive requirements that were generating all those waivers. The specific LTV ratios, the equity minimums, the portfolio concentration limits, and replaced them with a principles-based framework requiring board-approved policies, qualified lending staff, and demonstrated risk management programs. The Federal Register for the 2016 rule is explicit, quote, the removal of the prescriptive requirements does not relieve the credit unions from setting appropriate limits. The NCUA board believes these internal constraints are necessary risk mitigation practices, end quote. Oversight didn't weaken. It shifted from checking boxes to evaluating whether the risk management processes actually works. That's what every other financial regulator in the country does. The ABA calls that a relaxation. NCUA called it modernization. I was there then, and it was modernization. I spent 33 years at the agency, and eliminating 1,000 waiver backlog of case-by-case loan approval, eliminating 1,000 waiver backlog of case-by-case loan approvals and replacing it with the same supervisory framework that OCC and FDIC uses is not loosening oversight. It's finally catching up to how the rest of the industry already operates. Come on, guys. The ABA economists described the elimination of loan level underwriting waiver process as if it were loosening of the cap oversight. Those are two completely different things. One is a supervision methodology. The other is a statutory lending limit. Conflating them is either misunderstanding of how NCUA regulations works or it's deliberate. You decide which. Claim 2, the member business lending cap is notional. The ABA podcast argues that between low-income designation exemptions, waivers, and bank acquisitions, the MBL cap has become essentially meaningless. Their words, not mine. I already told you where the cap came from. It was a political deal, not a carefully calibrated safety and soundness limit. So when the ABA complains that the cap is full of holes, what they're saying is that the political bargain their industry helped negotiate in 1998 didn't hold up the way we had hoped. That's a political grievance, not a regulatory one. And every single mechanism they're complaining about was put there by Congress, not by NCUA acting unilaterally, not by credit unions gaming the system, by Congress. The low-income designation exemption is in the Federal Credit Union Act itself, the act of Congress. The waiver process has statutory basis. The bank acquisition pathway was never prohibited. If the ABA thinks those statutory exemptions shouldn't exist, they should go to Congress and make that case. But calling it circumvention implies credit unions are doing something underhanded. They're not. They're using mechanisms Congress deliberately authorized. Using a lawful exemption isn't circumvention, it's compliance. I pulled the number of credit unions currently operating above the 12.25% cap from NCUA call report data. As of the end of the year, 2025, it's 285, up from the 184 in 2021. But every one of those credit unions is using a mechanism Congress authorized. That's not a loophole. That's the system working as designed. Claim 3, the low-income designation explosion. The ABA makes a lot of the fact that the share of credit unions with a low-income designation rose from 6% in the year 2000 to over 54% today. They frame this as suspicious, as if credit unions are gaming a designation to avoid the NBL cap. Let's look at what the data actually shows. NCUA's call report analysis confirms the total number of federally insured credit unions has fallen from 5,048 in 2021 to 4,374 by year-end 2025, a drop of over 13% in just 4 years. The industry is consolidating rapidly. I recently did a podcast on mergers a couple weeks back. If you're interested in that data, take a look on the podcast from mid-March. So when the ABA points to a rising percentage of low-income designation credit unions, part of what they're seeing is simply a shrinking denominator. Fewer total credit unions means the percentage rises even if the raw count of low-income designated institutions stays flat or declines. And the lid credit unions who take advantage of subordinated debt so they can serve their members, who take advantage of not having the member business loan cap so that they can make loans in their community, makes sense that those might be the ones that would survive because they're serving the entire purpose of what they can do. But more fundamentally, why has eligibility grown? The criteria for low-income designations, again, shocker, are set by statute and regulation. They haven't been dramatically loosened. What changed is that NCUA has done outreach to encourage eligible credit unions to apply for a designation they were already entitled to. And demographic changes over the past 25 years have genuinely expanded the universe of credit unions serving lower income communities. The ABA wants you to see a conspiracy. The data shows a regulator encouraging eligible institutions to take advantage of a congressionally created designation. Claim 4. All of these are laughable, but this one is quite laughable. NCUA lacks the expertise to supervise commercial lending. I take that personally, and I say that as someone who's, again, spent 33 years at NCUA. The ABA says, and I'm paraphrasing, the NCUA probably lacks both historical and current expertise to supervise commercial lending. Their evidence? Bankers on their commercial real estate committees say that credit unions will do some loans that bank regulators wouldn't allow. So let me get this right. Low-income designated credit unions are getting served by credit unions making loans, and they must be bad loans because banks wouldn't make them. That's not evidence of supervisory failure. That's evidence of competition. When a credit union offers a loan that a bank won't, or at a lower rate, it might mean the credit union has looser standards, as they imply, or it might mean the bank regulators are overly conservative, or it might mean that the bank is overly conservative, or it might mean the credit union has a different relationship with that borrower. You can't tell from that anecdote. What I can tell you that NCUA has had member business lending regulations since the 1980s, updated comprehensively in 2003, and modernized again in 2016 by one of my members of my team, Vin Veaton, who helped rewrite the rule. NCUA has specialized commercial lending examiners. They have, some would argue they have too many commercial lending specialists, but it's not an area they ignore. It's an area they get hyper aggressive on. The agency also has concentration risk guidance, interest rate risk requirements, and net worth standards that apply to commercial lending activity. So is NCUA's commercial lending supervision identical to what the OCC does for large banks? No. Should it be? No. Credit unions are different. They're member-owned cooperatives, not investor-owned corporations. But the claim that NCUA is asleep at the wheel on commercial lending supervision simply doesn't match the reality. Now, I'll throw one caveat out there. NCUA, I've talked about this a lot. NCUA has lost 27% of their staff. They lost a lot of good staff. But the one area they were overhired in my opinion, was on regional lending specialists, which includes the specialization of commercial lending and understanding that environment. And by the way, every banking regulator is dealing with that because they all had to deal with the Trump mandate to shrink. So is the ABA criticizing banks and the OCC for shrinking? No, they're not. They just want to attack credit unions, in my opinion, that is. Claim 5, the bank acquisition commercial loan comparison. The ABA's economists pointed out that credit unions that have acquired banks carry nearly 20 times the level of commercial loans as credit unions that haven't done acquisitions. They present this as alarming. I want you to think about this for one moment. When a credit union acquires a commercial bank, what does it acquire? A commercial bank's portfolio. Of course, the commercial loan balance is dramatically higher. Part of that's because they didn't have a 12.25% cap thrust upon them because the banks wanted it to be there. Why? Because it's profitable. So that's the entire nature of this transaction. That's a mathematical identity dressed up as an alarming finding. It tells you nothing about underwriting quality. It tells you nothing about delinquency rates. It tells you nothing about whether NCUA supervision is adequate. It tells you that when you merge a commercial bank into a credit union, the credit union ends up with more commercial loans. Oftentimes, that's the whole point of the merger. Now, if the ABA wants to make an argument that post-acquisition integration creates examination challenges or that the combined entities need enhanced supervisory attention, that's a legitimate conversation. I've had that myself, but that's not what they said. They presented a mathematical inevitability as evidence of a problem. Claim number 6, these loans haven't been through a stress scenario. The ABA argues that because most of the growth in member business lending happened during an economic expansion, we don't know how this portfolio will perform when things get tough. And on the surface, that sounds reasonable. But let me give you a comparison they conveniently left out. Bank commercial real estate delinquencies peaked at 9%. 9% in 2009 and 2010, following the financial crisis. 9%. And that was under the supervision of the OCC and the FDIC and the Federal Reserve. The very regulators the ABA is holding up as the experts that NCUA should inspire to emulate. Current credit union commercial loan delinquency as of year-end 2025, about 1%. I know that because I pulled it myself from NCUA's call report data. And if you use the 60-plus day delinquency definition, which is actually a more standard comparison to bank CRE figures, it's 0.44%. against the 9% worst case in 2008, 2009. Now, to be fair, credit union commercial loan delinquency has been rising, and that's worth watching. I've talked about it here that delinquency collectively in the industry is over 1% for the first time in more than a decade. NCUA itself has identified credit risk as a supervisory priority. But we're talking about a delinquency rate that is a fraction of what bank CRE produced during the actual stress scenario of 2008 and 2009. And oh, by the way, NCUA does have credit unions do stress tests on when they have concentration risks. I've seen it when I was at NCUA, and I see it and hear about it in my conversations with credit unions today. These loans haven't been tested argument cuts both ways. History shows us which system produced the systemic crisis. It was banks, not credit unions. Which institutions had horrific delinquency in 08, 09? Banks, not credit unions. So again, you be the judge of what they're trying to do here. And here's something the ABA really doesn't want you to think about. Former NCUA Chairman Todd Harper, someone who spent years overseeing the credit union system from the top, said it plainly in the same podcast I mentioned before. Well-written and well-underwritten member business loans have the ability to perform differently in different economic cycles than auto loans or mortgage loans. And that, he said, is good from a safety and soundness perspective. Diversification into business lending isn't a risk to the system. Done right, it's a protection for the system. The ABA is arguing it exactly backwards. Claim 7, the small business satisfaction data. The ABA economist cites the Federal Reserve Small Business Credit Survey to argue that small businesses consistently prefer banks over credit unions for their lending needs. And they're right that the survey shows higher satisfaction scores for banks. But here's the methodological problem they don't mention. That survey measures satisfaction among approved applicants at institutions they chose to apply to. If credit unions have membership eligibility requirements that filters who applies in the first place, you're comparing different populations. Apples to bananas. You're comparing different populations, like apples to bananas. The members who chose their credit union and got approved for a loan is a fundamentally different survey respondent than the small business owner who walked into a community bank. Beyond that, credit unions consistently score among the highest of any financial institution type in the American Customer Satisfaction Index, year after year across the full membership, not just business borrowers. The ABA knows this. They chose a survey that supports their argument. That's advocacy. That's fine, but don't call it objective economic research. Claim 8, the level playing field and the tax exemption. The ABA argues that the combination of credit union tax exemption and what they characterize as looser underwriting creates an unfair pricing advantage. This is the oldest argument in the ABA's playbook. They've been making it since the 1990s. The credit union tax exemption exists because credit unions are member-owned cooperatives. They don't have outside shareholders. Their earnings return to members through lower rates on loans, higher returns on deposits, and reduced fees. The tax treatment reflects the cooperative structure, not a subsidy that Congress has overlooked. And banks are not exactly operating without tax advantages of their loans. Deductions, tax-exempt bond income, FDIC deposit insurance, federal home loan bank access. The playing field is not even as the ABA would have you believe. Congress has reviewed the credit union tax exemption many times over many decades and has chosen to maintain it. That's not an accident. What this is really about, I want to be clear about something. The competitive tension between banks and credit unions is real. You know that better than me because you're listening to this podcast. When credit unions grow, when they expand their field of membership, when they acquire banks and take on commercial lending portfolios, community banks feel that. That's real competition for real customers. But there's a difference between making a legitimate competitive argument and producing what is essentially a podcast dressed up with charts that we can't see and data points that don't make sense. The ABA podcast presented advocacy as analysis, in my opinion. It cited data selectively, in my opinion, and I think if you listen to what I said before this, you probably agree. It made alarming claims about systemic risk based on a commercial delinquency rate that is a fraction of what the commercial rate was during the crisis. And if you compare the crisis rate in banks to what happened in credit unions, it was 7, 8, 9-fold. And their proposed solution, congressional hearings or an enhanced oversight, conveniently aligns with the ABA's longstanding legislative agenda to restrict credit union growth. What does the actual data show? Credit union net income for the full year ending 2025 was up over 30% over 2024. I pulled that from their call report data. The aggregate net worth for federally insured credit unions stands at 11.28% as of the end of the year, well above the 7% well-capitalized threshold. And member business lending has grown steadily from $109 billion in 2021 to $185 billion in 2025. That's real growth, but it is steady, consistent growth over 4 years, not the explosion the ABA describes. So I understand rough justice. Sometimes you made a broad point and the details aren't perfect. I use it myself sometimes, and I say the term rough justice. But rough justice that produces wrong conclusions and leaves innuendos hanging in the air about an industry's safety and soundness is not analysis. It's a talking point. The ABA is entitled to their talking points. The credit union industry is entitled to the facts. The ABA's framing of this as a systemic risk emergency requiring congressional intervention, that's a political argument, not a safety and soundness argument. And up to this point in time, Congress has known the difference too. So my takeaway for credit unions, if you're a credit union executive or board member, here's what I want you to walk away from with this episode. First, know that this argument isn't going away. The ABA will keep making the case that credit unions have strayed from their original mission. They have the resources to fund studies, generate media coverage, and push this narrative on Capitol Hill. You need to be prepared to counter it with facts, with your own story, with data about who you serve and what you do for your members. That's why I go to America's Credit Unions GAC. That's why I'm thrilled every time I see 6,000 credit union people there hiking the hill. You hike that hill, you tell your story, and you will keep this nonsense from the ABA at bay. Second, the best defense against these arguments is running a good credit union, maintaining appropriate capital, having strong underwriting standards for your business loans, building in the risk management infrastructure that justifies the trust that your members place in you. When your institution is well run, the ABA's arguments find nobody who wants to listen. Third, engage in NCUA's supervisory process proactively. Don't wait for the examiners to find problems with your commercial lending program. Have the policies, the staff, the concentration monitoring, and do your annual follow-ups. By the way, that's one of the things when we get brought in to have conversations with credit unions and commercial lending, the one thing that can always be done a little bit better is those annual reviews. Show the examiners you're on top of it. That's how you get through your exam with flying colors. And that's what we're here to help you do. And fourth, be skeptical of data without context. When someone cites a statistic without explaining what it means, what it's being compared to, and what they're leaving out, that's usually a sign that you're dealing with advocacy, not analysis. All right, that's all I've got for you today. I hope you found this episode helpful. If you wonder how I come up with my podcast topics, sometimes it's listening to another podcast and concluding, hell no, that's wrong, and that's what this podcast was about. As always, I want to thank you for watching. Thank you for listening. This is Mark Treichel, signing off with flying colors.